Hi, and welcome back again to Tim Bigham's Options and Volatility Newsletter. Taking a look at our closeout, a one-day wonder trade as IV reverted overnight, money for nothing with the stock going nowhere, making some very nice gains on our trades in Arrow, Copper, ERO. So let's jump in and take a look, shall we? Here's the opening trade. This was actually from Wednesday, right? Anyone who didn't see that can go to the link up here. But it was basically coming out because of huge repeat call buying, especially that spiked the implied volatility to extremes, to say the least, that set up ideally for some vol capture trade. So to walk through the opening trade idea, right, the trade idea generation, we can do it quickly here. Again, you can go back to the previous link from Wednesday, but here's the scanners, right, that I use. Here's ERO on my one that I built on the Thinkorswim platform. Here's another option scanner I use. You can see over 40,000 contracts traded, 30 times the normal volume. IV at the highest level of the year, sets up ideally for a vol capture trade. Here's that huge run up in implied volatility. As we can see, I'm just using the 60-day IV, but you can see that massive spike. So we're looking to sell into that in a fairly neutral fashion, although the covered call leaning bullishly with that call buying out there. You can see that run up in IV2 from the prior day in red to Wednesday's close there. You can see over 40,000 calls traded, less than 1,000 puts, right? You can see the calls and the IV generally just off the charts, ripping higher from the prior day. We can also take a look at it from where it was before the at-the-money generalized IV, hanging right around that kind of mid to upper 40 level, crept towards the lower 50s, then boom, explosion here. Note too that the call IV, because of the massive amount of calls being bought, has exploded where the call IV is now 10 points higher than the put IV. Again, a sign things might be getting extreme. Here's a look at a 1-month IV chart for a 60-day kind of slightly out of the money call and put both. You can see just slowly kind of creeping, and then boom, that huge volume coming in, especially on the calls, spike the IV. So set up ideally for a covered call trade, buying the NOV or selling the NOV 25 calls versus the stock, a strangle trade, right? Selling the NOV 20 put, NOV 30 call, right? Which that strangle had almost doubled in price simply because of that huge jump in implied volatility. Going out a little further, selling the Jan 25 straddle, right? And with the stock at 23.5 roughly, put is in the money, calls out of the money. So leaning a little bullishly, although the deltas will tell you not, because that huge jump in implied volatility kind of pushed the call IV higher than it should be, made the put IV a little bit less. So, but certainly selling that straddle made a lot of sense too. We took a look at from a margin standpoint, selling that strangle, right, the NOV 2030 strangle, would take a little bit less than 1,000 to do it one time in margin. The straddle, the Jan 25, a little bit less than 1,500. So we actually did do that trade. We'll take a look at the fills here. So here it is, in essence, from Thursday morning, right on the opening, right, 14 seconds in the trading, right, we went out, we sold that Jan 25 straddle, right, for $6.36. As you can see here, the IV on it at 64 and change. The stock was at 23.82 at the time. A little bit later on, right, we sold that NOV 2030 strangle, right, for $1.55 with the IV at over 80, right? The stock at 23.96 at the time. So we got into the trade at a little bit better prices than we talked about on the original trade ideas, simply because IV on the opening actually popped a little bit more. Fast forward to Thursday, right after the opening, we're able to close out both the trades for a nice gain. That strangle, right, the NOV 20 puts we sold, the NOV 30 calls we sold, reverted. We're able to buy it back at $1.08. We sold it, we said, initially at $1.55. So the net gain on the trade, $47 for each one we did, right? margin needed a little bit less than a grand, so our return a little bit more than 3.5% just on a one-day overnight trade, right? You can see the delta, on these options, right? We'll move this so it fits here. But you can see that when we did the initial trade, the call delta was at 26. The call delta now with the stock virtually the same price. Remember, we did that no strangle with the stock at 23.96. We covered it on Thursday, right? This was on Wednesday's opening. On Thursday, the stock virtually at the same price, right? A penny and a half cheaper, right? But the delta change, why? Because the IV has dropped sharply, especially on the call side, moving from 87 and change to 73 and change. So a huge drop on that call IV. As we said, the calls were trading at such a big premium, right, to where they normally should be by over 10 points. So selling those calls certainly made a lot of sense, which way that covered call made a lot of sense as well. We also can take a look at our Jan straddle that we are able to buy back about an hour later on Thursday, right? Buying it back at $6, right? Making 36 bucks on the trade, margin on it again, a little bit more than 1,400 bucks. So 2.5% roughly gain on the trade again for a one-day trade. The stock here again did not move at all, was at 23.82 when we put that Jan straddle on, 23.81 when we covered it. So virtually the same stock price, a penny difference, right? But the main reason we're able to capture that gain, IV, when we sold the trade at the time, as you can see, 64.64, able to cover it here at 61.23. So longer term IV, if it drops, it has a bigger effect on the pricing the longer out in time you go. And again, our net gain on the trade about 2.5%. So here's a quick look at that reversion, right, which led to it. Here's that chart. Here's where we sold it up here on basically Thursday's opening. Here was Wednesday's close, covered it when it reverted back down. You can see IV reverting across the board here. Here was that huge jump right to 72.30 we talked about, and then the reversion back. You can see the term structure, vol, and the skew both flattening very nicely. That skew, right? Now, virtually back to flat. It had been hugely where the out-of-the-money calls were trading at such a rich IV. Also note, too, that the overall current IV percentile dropped to 59% when we put the trade on back here, right? You can see that IV percentile was at 70%. So certainly a big reversion as well. And note that the volume is still out there, but not nearly at that 40,000 level. Hence that reversion. Once the volume dries up, you almost always see that reversion. And here you can see things quieted down dramatically. So to put it in a nutshell, here is what we always look to do when we identify these sort of situations, right? We look to sell that rip, right? And that was what we looked at here. Here is that rip, right? We look to sell into this. And then when we have that reversion and we're not looking for it to go all the way back here, we buy that dip. So that's how we look to always take advantage of this. And taking a look at our kind of fills here again, here's where we bought the first piece back. Here's kind of where we bought the second piece back, right? So you can see that, things really hadn't changed. But to be honest, if things had changed, I pulled off the closing price from Friday. The stock dropped back down to 22.08 as it dropped sharply. But that no 2030 strangle, right, still pretty much priced at where we closed it out. So even though the stock got further away, right, because IV dropped even a little bit further, that trade didn't get away. And the straddle, right, actually got a touch cheaper, pretty much at the same price. We bought it back at 6, trading just a touch under, even with the stock moving further away from 25. So this highlights again how taking advantage of implied volatility spikes, right, these huge jumps in implied volatility caused by unusual option activity, right? Which once the volume dries up, IV almost invariably reverts back to where it was before. Structure the trading, leaning a little bullishly with the call buyer out there, or neutral if you're just looking for a vol capture trade, but able, if you will, to capture some very nice gains overnight, right? A little over 3.5% gain here, 2.5%, a little more than that there, with the stock virtually going nowhere. So all this is caused by that big IV reversion, right? From selling over an 80 IV, covering at just over a 70 IV, selling over a 64, covering at just over a 61. So trading IV as a big component of your trading can lead to very nice profits indeed. So until next time, as always, here's the good trading. Take